Right, good morning everybody. Hope everybody can hear me. Right now we are spending now the third week on consolidation. So on the very first week relating to the group accounts, I discussed some introduction for business combination and consolidation. So these are the slides we have already used. And if you can remember, I just run through this to summarize. We learned about amalgamation, absorption, and we came into consolidation. Finally, we learned different types of investments made by one company or one entity in other. Accordingly, we learned about simple investments, associates, subsidiaries, and joint ventures. Then we came into the discussion on investments in subsidiaries. Accordingly, we learned parent, subsidiary, and sub-subsidiary relationship. Maybe in different forms, but we know now what is subsidiary, what is a parent, what is a group, what is control, etc. And we learn about NCI as well. Then we came into a consolidated financial statements. If you can remember, I told you, I'm briefing the thing again. I told you that there are two entities as A and B. They will prepare their own individual financial statements, right? At the same time, the parent will prepare another set of financial statement called group financial statements, right? So that's what we call a consolidated financial statement. Very simply, it is done by parent on behalf of the subsidiary and parent together. We call it the group picture. Here the group picture we do. So this is group accounts we prepare, right? So but in addition, individually they will prepare, the parent and subsidiary will prepare their own individual financial statements. In addition to individual financial statements, parent will prepare their own the group financial statement, including its subsidiaries and sub-subsidiaries, right? Then some theoretical aspects. We learn this kind of different scopes. And thereafter we came into consolidated statement of financial position. Actually today I am expecting to complete the group account section. And I think this is third week on group accounts. It is more than enough for group discussion. So therefore we'll see what we can do today. I'm planning to discuss at least one or two questions from group group balance sheet or group statement of financial position. And also I'll discuss something about group income statement today. With that we will wind up the discussion on group financial statements. Right. So then we came into questions of group financial statements. Accordingly, if you can remember, I first started with statement of financial position, giving different examples for different adjustments in group financial statements. If you can remember, with this question that you can see on the screen, we discussed about cost of control account. I told you the purpose of cost of control account as comparing investment, one side investment, and this is investment, and this side we call actually net assets on the acquisition date. That difference we call goodwill, or we learn another term called profit on bargaining purchase. We did line by line consolidation, having equal line items together. You can remember, like here 60 plus 20 80. But when it comes to equity, we don't take all equity into group financial statements, so then equity should be accounted separately in group accounts. Accordingly, the total equity at the time of acquisition date we took into cost of control account to calculate goodwill by comparing with its investment. So then if you can remember, we learned the term called goodwill and profit on bargaining purchase. But remember, in the goodwill we use full goodwill method. There are two methods we call full goodwill method and the proportionate goodwill method. I didn't do actually proportionate goodwill every time. Now we are going with full goodwill method. Accordingly, non-controlling interest. Non-controlling means the controlling interest which is not governed or the controlled by the parent is accounted at fair value. We calculated non-controlling interest fair value, and if you can remember the double N for NCI fair value, cost of control debit, and NCI account credit. So then if you can remember, I told you this story. This side 80% we take as investment. So then this side we take 100% of equity. This side we take equity in the cost of control account. So then to make this side 100%, we add 20% of fair value if you take it as 80% acquisition subsidiary. So then 20% fair value of NCI should be taken in this side, then this will become 100%. Then 100% of net investment should be compared with 100% of equity. So that method we call full goodwill method. That's why we recorded NCI double entry, NCI, fair value of NCI as, if you can remember, fair value of NCI, cost of control debit, this is cost of control account, cost of control debit and credit to non-controlling interest account. So I told you if the investment on the acquisition date is, look here, investment on the acquisition date is less than the net assets on the acquisition date, net assets on the acquisition date, net asset on the acquisition date, look this sum 30. We call it goodwill. We call it goodwill, right? Sorry, made a mistake, right? Here it's profit on bargain in purchase. Profit on bargain in purchase. Look here, the investment is less than, this investment is less than fair value of net assets on the acquisition date. Fair value of net assets on the acquisition date this side. So this one we call profit on bargain in purchase. Double entry is here debit and we credit it to consolidated retained earnings. Consolidated retained earnings, right? So then if it is other way around, look here, the investment is 35 but net assets on the acquisition date is 30, then this difference we call goodwill. We recognize it as goodwill on business combination and should be tested for impairment. So therefore goodwill should be recognized as separate asset in books of accounts. But remember, if there is any impairment relating to goodwill, last week we learned, it should be subtracted from this side, right? So if there is any impairment, we call it impairment loss. It should be accounted like how, if you can remember, last week I summarized everything. Impairment loss, here credit and where to debit. It should be split into two. In this example, it's fully owned subsidiary. If it is partly owned subsidiary, let's say 80%, 20% story. If it is fully owned subsidiary, directly goes to consolidated retained earnings. If it is partly owned subsidiary, that relevant percentage should be taken into consolidated retained earnings, balance should be taken into NCI. Then double entry for impairment loss, if you can remember, goodwill account credit, consolidated retained earnings debit and NCI debit, right? So that's about, then if you can remember, I told you now 4 concepts. Last week also I summarized everything. Now no need to tell everything again and again. We learn about goodwill and fair value of NCI, and also if you can remember, we discussed something about fair value excess of property, plant and equipment. So that excess I told you should be recognized as part of tangible asset, and also it should be recognized as how, if you can remember, as part of equity on the acquisition date. And also remember, we have to charge depreciation if it is so. If there is any under provision of depreciation on this fair value excess, it should be recognized as expense for the year. Therefore, consolidated retained earnings debit and we credit it to property, plant and equipment account. All right. Then we learn about pre-acquisition and post-acquisition profits. Pre-acquisition means all reserves on the acquisition date. I told you pre-acquisition reserves should be charged to reserve account debit and cost of control credit to calculate goodwill or profit on bargaining purchase at the time of acquisition. And all post-acquisition reserves should be charged to reserve account debit and credit to consolidated reserve or consolidated retained earnings and NCI account. Here this part is wrong, huh? I told last time. Right. This question also we did. I don't want to do it again. And remember, example number 10 I discussed last week. This one I discussed last week as a last question. I am not sure whether I discussed example number 9. Little Little difficult question. Anybody who participated for the last session? Did we discuss example number 10 last week? As I remember, I discussed example number 10. Not about example number 9. Theraj? Right, let's start with example number 9 to recall everything that we have learned up to now. I think we didn't discuss about example number 9 last week. I did only example number 10. Is it so? Anybody who is online, whether you just see whether I have done example number 9 last week? I think not so. Okay, let's start with example number 9. Nobody is there, I think. Right now, there are two entities as A and B, and their statement of financial positions are given. And now there are set of adjustments there. It is 60% purchase subsidiary here, it's very clear. And with that, that's the only thing we have to take. And the second point, as of acquisition date, fair value of B Limited's property, plant and equipment were rupees 3,200. Simple amounts we have, doesn't worry. And that of investment was 2,000. Right, now what has happened? Just see the timeline. What is our acquisition date? What is the year end is 31st December. Year end is 31st December 15. Then year beginning somewhere here it should be 1/1/15. And this acquisition happened on the same date. On this date, this acquisition happened. 60% purchase. Right. This is a model. And on that date, we had retained earnings on the acquisition date. It is given here again. It was 1,000. These are some information we need actually. Fair value of NCI also given. Now actually for these two we can account. Now I have format here. Look here, this is my cost of control account. I'll take this as let's say NCI. Let's say this is consolidated retained earnings. And this is retained earnings of subsidiary. Right? These are the accounts I need. Now, first entry that I am going to pass for this thing, we'll do this fair value of what is called fair value adjustment for PP and investment later, but there are two other amounts. Sorry. There are two other amounts here. Retained earnings on the acquisition date and fair value of NCI. We can pass this too. You know, retained earnings on the acquisition date means pre-acquisition reserves. We can account for pre-acquisition reserve here. 1000, retained earnings of subsidiary debit 1000 and credit to cost of control account. This is pre-acquisition reserve. Also, you know the double entry for fair value of NCI. NCI of fair value of NCI debit to cost of control as 2500 and credit to NCI account. These are the entries we can pass easily. $2,500, right. Now we will do about this fair value adjustment. What it says? On the acquisition date, fair value of NCI is 3,200. On this date, fair value of NCI, I am going to use different color now. Here it is 3,200. This is fair value. Fair value of property, plant and equipment. But what is the book value of PP now? Look here very carefully. Now we are talking about B's financial statements here. Now it's 1,200. Accumulated depreciation here 3,000. Then net value, written down value, look, written down value at the end of the year. It means now here 31st, this is 31st December. Here 1st January. This is acquisition date. All are 15. Right? Here the value is now 1,800. Not here 1,800. Net book value. As you guess, what is net book value on this date? You just see another information. Both these companies are depreciating their assets at 10% on cost. Both these companies are depreciating their assets at 10% on cost. Now we need to find out fair value excess. How to find out it? 10% means, look here, the cost is 3,000. 3,000 into 10% means per annum depreciation will be how much? 300. Now look here, we have 1,200 depreciation. It means this asset is how many years old? According to this calculation, PP depreciation for a year should be 300. Understand? But this is now 300 into 3. That's why we have 1,300 in accumulated depreciation there. Right here, accumulated depreciation 1,200 means 3 years old asset. It means if you back 300 here, now accumulated depreciation here 300. Then on this date my cost remain unchanged 3,000. My accumulated depreciation should not be 1,200. It should be only by 900. This asset is 3 years old asset. Now all these values are given on this date. Now here what has happened? Now you will take this one, 3,000 minus 1,200. Then it is 1,800. Right? But here depreciation for a year should be 900, means from this 1,200 we have to subtract this 300, then accumulated depreciation on this day should be 900. It means net book value on this day should be 2,100. Look the way that we find out net book value on the acquisition date on this PP. Understood? Actually what we did, we reversed depreciation for the current year. And we went back to the beginning of the year, which is the acquisition date of this example. Understood? So now what is my fair value as they have given 3,200? Then what is fair value excess? It is 1,100. This is fair value excess. How to account for fair value excess now? This 1100 should be added to, now already we have learned the double entry for fair value excess. Property, plant and equipment account debit, and we have to credit. Credit to where? So where should be credit now? Credit to cost of control account. Now we have already identified fair value excess in this question. Then double N should be 1100. Here credit, this is fair value excess. Fair value excess of property, plant and equipment, and debit to property, plant and equipment. I will just add it here. PPE 1100 plus. We will finalize amounts later, right? Then, but another question we have is, we have to depreciate this asset. Now, what should be the depreciation amount of this asset according to this example? How much they have depreciated for the year? Now we are going to calculate depreciation for the year. How much is the calculated depreciation for the year? It's 300. What should be the depreciation for the year? How much it should be actually? Anybody can say what is depreciation for the current year according to this now fair value? Now already it has been adjusted to this much. What it should be? 3200 divided by how many years? Anybody? Actually now from this point onwards, now if you look at the accumulated depreciation from this point on, this point back, actually this asset is 3 years old. If you stand on this date, this asset is 3 years old. Sorry, 4 years old. I made a mistake. 4 years old. Because we have 1200 depreciation means 1200 into 3, 1200 into 4, right? So therefore this was 4 years old asset. Now this is already 1 year gone. Now this year, it means from this year back there are how many years? 3 years. 3 years back. That's all. 3 years plus 1 year. It will be total. Total of 4 years. Understand? So therefore now from this point onwards, how many years remaining we can consider as remaining useful lifetime? Now 3 years back we have purchased this asset. Total 4 years back we have purchased this asset, but from this point back we have only 3 years because now we are calculating from this point onwards. Right? So therefore now this asset is actually 7 years remaining useful lifetime. Therefore this 3700 should be divided by 7 to calculate depreciation for the current year. 3200 divided by 7 means my depreciation should be around 457. How much they have depreciated already? Look here. They have depreciated 300. My depreciation should be 457. Now how to account for? Just see how to account. Now under provision of depreciation actually we call the correct depreciation should be 457, but they have depreciated only 300. Hope you understood how did I get this 457. Now it is based on the accumulated depreciation, right? So then depreciation, how to charge depreciation? 157 property, plant and equipment 157, PPE account credit and debit it to where? Subsidiaries retained earnings as 157. This is depreciation. Depreciation. Understood? That's all about. There is another one more thing. Look here. Investment on that date was 2000. But here what is my investment? Investment here is 1000 500, then there is fair value excess on investment is about 500. How to account for that one? Again, cost of control credit, this is from PPE, this is from investment. Fair value excess on investment is 500. Cost of control credit, investment account debit, here investment, plus 500. Right. It is also done. Both A limited and B limited depreciate there, right? That's done. Now, right, all adjustments are done now. Yes. This is the biggest adjustment in this example. Only difficulty is getting depreciation reverse in all accumulated depreciation for the year, because a number of lifetime and everything is not given. Hope you can understand this. Right. So now I can finalize this work by line by line. Now I can take this written down value, what has happened here, 3300 plus 3300 plus 1800. There are two adjustments for property, plant and equipment, plus 1100 minus 157, here it should be 6043. Then second line about investments, this investment is maybe investment made in subsidiary, therefore that investment should be taken into this thing as cost of control, 3000 investment, and the subsidiary's investment 1500, it will come in, it will be now 2000, 1500 plus 500, 2000. Current assets, no change, therefore we can take it as it is, sum of these two, 3900. Current asset, $3,900. And equity, parent's equity we can record as it is 4000 and subsidiaries one is 2500. Here share capital 4000 and subsidiary share capital 2500 we charge to cost of control account. This is share capital. And retained earnings 3500 and 1700 in consolidated retained earnings. Here 3500 and here 1700. These are brought forward balance. And non-current liabilities, no change, and current liabilities also there is no adjustment, therefore 1800. Here non-current liability 1000 and current liability 800. Right, done. Now I have taken all the amounts from the given balance sheet. Now we will see this thing. What is post acquisition reserves in this one? 1700 minus 1157. Here 543, this is my post acquisition reserves. This should be split into two, as 60% and 40%. That into 60% means 326 minus 543 means 217 to NCI. 217 to NCI. And you can see now cost of control and find goodwill or negative goodwill. Let's see, 2500 plus 3000 minus 1000 minus 1100 minus 500 minus 2500. Goodwill is 400. Yeah, goodwill is 400. Yes, right. So now goodwill I will take into this. And NCI, before that actually consolidated retained earnings. $2,770 and made a mistake. This is NCI, no? NCI here 2,770 and consolidated retained earnings 326 3,826. You see the total here. It should be balanced now. Let's see. Balance in figure will be 12,343. Here also 12,000. Let's see whether it is so. Yes, 12,343. It is balanced by 12,343. Right? That's done. From this adjustment, actually, we learn how to incorporate depreciation and fair value excess on property, plant, and equipment. Let's move forward. This question we did last week. Last adjustment that I am going to discuss with you, it's about unrealized profit. Right? So if you can remember, I told you this picture, if you look this picture very carefully, entity A and B, let's assume this is parent and subsidiary, B is subsidiary. A will prepare their own financial statements, B will prepare their own financial statements, but A will prepare another set of financial statement called group financial statement having all these subsidiaries. We call it group accounts. Now thing is actually what standard says very simply, total unrealized profits arising on intercompany transactions should be eliminated in full. So if you look a simple example, let's assume. First thing we'll see, actually this is happening in the case of Intercompany transactions. Basically, there are two types of intercompany transactions. Actually, the intercompany transaction of selling goods, which are purchased for resale, and selling fixed assets. Therefore, actually in this adjustment, there are two things to be done. One is sale of goods or sale of inventories, another one is sale of fixed assets by one entity to other inside the group, remember. So therefore, I am going to discuss first intercompany trading of inventories. Intercompany trading of inventories. Very simply look this. There are two kind of scenarios actually. Right. Then first part, look this kind of thing. Let's assume in this example, I have drawn here, it's easy to understand. You buy something for 150 from outside to entity A and you sell it to entity B inside the group for 200. Now look what has happened. Entity A purchased some set of goods from outside. Then it will be recognized by A as their own purchase. Then when they buy something, how A will record this thing? Purchase account debit and cash account credit. So then what they do, entity A does, A will sell the same amount of goods, 150 worth of goods, by adding 50 margin, by adding 50 profit to entity B inside the group, right? If entity B sell everything to outsiders by the end of the year, let's say for 270, then what is total profit earned by the group in this scenario? Something came in for 150, came out for 270, means there is 120 profit inside the group. Therefore, there is nothing called unrealized in this kind of nature transaction. Why? Entity A bought something outside the group and sold to outside the group by entity B. Anyway, that 120 profit is to the group. But let's assume by the end of the year, entity B has not sold anything to outsiders. These inventories are with whom? With B. What happens in the scenario? Entity A purchased 150 worth of things from outside entity, let's say from entity X. Entity X, A bought, but everything sold to B by adding 50 margin for who? 200. Then that 200 is 200 worth of inventory is finally with whom? With entity B. Therefore, look in this transaction, therefore there is intercompany trading, intercompany transaction. A sold goods to B by adding 200 margin. Therefore, look what has happened. Since A sold goods to B by adding 50 margin or 50 profit, and B has not sold anything to outsiders. B has not sold anything to outsiders. Not sold anything to outsiders. So what has happened? There is artificially added profit of 50 inside this. We call it, what is it? Unrealized profit. Understand? So then the artificially added profit which is not realized to the group, we call unrealized profit to the group. What standard says, unrealized profit should be eliminated in full. Unrealized profit should be eliminated in full. Understood? Right. Let's see this example. Not that, wait. I'll come to the example later. I'll take the same example. Now, how to account for this unrealized profit? We need to reduce unrealized profit. What has happened in this scenario finally? Who added the profit? In my example, in this example that you see on the screen, A sold goods to B. Therefore, A added profit of 50 artificially. Therefore, that 50 profit will be included in A's retained earnings. Therefore, what we need to do? Unrealized profit should be eliminated in A's retained earnings. Therefore, consolidated retained earnings O, in this my example, parents retained earnings debit. Parents retained earnings means A's retained earnings debit, and we have to credit. Who has overstated inventory? Who has overstated inventory? It has been done by B. So therefore, consolidated inventory anyway B's inventory should be credited. B's inventory should be credited. Anyway, what we have to understand very simply, I am not going to explain further. What you have to understand is artificially added profit by the seller should be eliminated in full. Every time the profit, this should be the same thing can be happening in other way around also. Let's say now, sometime this kind of one, let's say this is parent, this is subsidiary. Then subsidiary is all goods to A, same thing. Let's say assume by adding 50 margin, then unrealized profit is 50. Then who is the seller? Seller is subsidiary. So therefore what you have to understand finally, unrealized profit should be eliminated from first seller's retained earnings. Therefore seller's retained earnings debit and consolidated inventory credit. Understand? We have to subtract it from inventory. Why? Inventory overstated. Therefore inventory value should be, now actually if there is any artificially added profit in group financial statements, what happens in inventories especially, there are two implications. One side your closing stock will be overstated because of this artificially added profit, and the other side because of this artificially added profit your retained earnings will be overstated. Both should be eliminated in full. Therefore what you can say, consolidated inventory credit and seller's retained earnings debit. So that's the entry you need to remember. What is the retained double entry? Remember it. Each double entry you just study these examples later. Double entry for unrealized profit, I will generalize it like this, then easy to remember. Every time unrealized profit, seller's retained earnings debit and consolidated inventory credit. Seller's retained earnings debit, consolidated retained inventory credit. Understand? It is the easy double entry you can remember. Even parent sell goods to subsidiary or subsidiary sell goods to parent, doesn't matter. You don't want to worry about that point. Only thing you need to remember is, remember to debit into seller's retained earnings, maybe parent or subsidiary, and credit to every time consolidated inventory. Right? You just see examples later. Look this example. GT regularly sells goods to its subsidiary in which it owns 60% of ordinary share capital. It means 60% owns subsidiary. And during the group's financial year ended 31st March 11, GT sold goods to its subsidiary valued rupees 300,000 at selling price. 300,000 at selling price. Upon which it makes a margin of 20%. I hope you can remember what is margin markup story. Right? Then margin means anyway on selling price. So if you take like now cost is, if so then you have to take selling price, everywhere you know cost plus profit equal selling price. This is generalized one. Then selling price will be 100, my margin will be 20, accordingly my cost will be how much? 80. So then out of this, 80% of these goods have been sold to third parties, outsiders. Remember important point, if something is sold to outsiders, then that profit will be realized. In this example also, in my previous example that I took, just see a minute. In this example actually what I told you, A sold goods by adding 50 profit to B, B has not sold anything to outsiders, to the group. Therefore, I took total 50 as unrealized profit. Got it? But let's assume in this case, B sold, let's say 40% of goods to outsiders. 40%. It means out of this 50, 40% is realized to the group, balance 60% is not realized to the group. Understand what I said? Now here total profit added is 50. Out of that 50, 40% of goods already sold to outsiders. Therefore, 40% of this profit is already realized. Balance 60% is not realized. Therefore, the unrealized profit in that case will be not 50, only 50 into 60%. It means 30. Understood? That kind of scenario is discussed in this example. Look this. Right. What it says. Now, what is your unrealized profit in this case? Unrealized profit. How much is it? Now, GT sold, GT means is parent or subsidiary. GT means parent. This is parent, this is parent. Huh? Right. Parent. Then 300,000 should be divided by how much? Selling price. Makes a margin of 20 means margin means on selling price every time. Remember, margin means selling price, markup means on cost. Then it will be 100. So then 300 divided by 100. Right? 300 divided by 100 into 20, then your total profit inside this will be 60. Right? 60. Just see this thing later. This is not the answer for this. This is something else. So then 80% of these had been sold to outsiders. Then out of the 60, 80% sold means only 20%. It means 12 will be your unrealized profit. $12 is unrealized profit. Right? So then how to account for this 12? Seller's retained earnings, seller who is a seller now, GT's retained earnings debit and group inventory credit 12. But if we say like this, if inventories are sold at not margin, if it is on markup, how to take? If it is markup, then the answer is there, look here. Then you take cost as 100, then profit will be 20 and selling price will be 120. In that case, if the value is given on selling price, this 300 should be divided by 120 and multiplied by 50, multiplied by 20, then it will be 50. 50 into 20% only unrealized, only 20% unrealized, then unrealized profit will be 10. Double entry, consolidated retained earnings debit, again same double entry, but 10. Remember whether they are talking about markup or margin. Based on that, your unrealized profit will be changed. Be careful, we will practice it later. Get the point first. Then another story is I'm going to discuss both first. Intercompany trading of fixed assets. Let's say a very simple example. There are two entities called P and S, what is called parent and subsidiary. Let's assume there is fixed asset here 4,000 and this fixed asset is, or let's say 100, and this fixed asset is sold to subsidiary for 150. It is possible, no? Net book value of parents, books of accounts is 100 and now it is sold to subsidiary for 150. Now what is artificially added profit by parent in this transaction? It is 50. Artificial added profits inside the group should be eliminated in full. Therefore what we have to do for this 50 first? 50 should be eliminated in my books of accounts. Therefore double N should be, what has happened now? If it is happened like this, again sellers retain earnings. Now look here, consolidated profit and loss account means when parent sold fixed asset to subsidiary, how to do it? Look, sellers, or better to say it is seller. Sellers retain earnings debit, fixed assets or property plant and equipment credit, because group property plant and equipment will be overstated as a result of this. Therefore, if any property, plant and equipment is sold by one entity to another entity inside the group with the profit amount, that profit should be eliminated in full. How do we eliminate it? Sellers consolidated retained earnings debit, property, plant and equipment credit. Why? Property, plant and equipment has been overvalued as a result of this artificially added profit. Understood? It's like inventory previously. In unrealized profit, anyway, artificial profit, added profit should be eliminated. How do define it now? Every time sellers retain earnings debit, and if it is inventory, credit to inventory. If it is fixed asset, credit to fixed asset. Understand? So that is first point. But in fixed assets, intercompany trading transactions, there is special case. What is a special case? We have to refer. We have to think about, if it is not a land, mostly we have to think about depreciation calculation. Depreciation. Understand? So if there is any artificially added profit to property, plant and equipment, on that the buying entity will provide depreciation. Therefore definitely there will be kind of over provision of depreciation as a result of artificially added profit. You can remember previously we discussed fair value excess of property, plant and equipment. If fair value excess on property, plant and equipment is not accounted, what was happened? If you can remember, depreciation undercasted, therefore we increase depreciation. If you can remember in the previous question, it was 157 or something. That was under provision of depreciation. That under provision of depreciation we increase accumulated depreciation credit or asset account credit and consolidated retained earnings debit, subsidiaries retained earnings debit, previous case. Now here what has happened? If there is any artificially added profit to fixed asset transactions, as a result, by the amount of this artificially added profit, your depreciation will be overcasted or overestimated. That overestimated depreciation should be undercasted or decrease. So how to decrease it? Depreciation account debit and credit to where? Again what I tell you, buyers retained earnings should be credited. It is easy way to remember, not like this entry. If there is any over provision of depreciation on fixed assets transaction, intercompany fixed asset transaction, again you can remember general double entry. How to remember it? We call it buyers, sorry, I will write the debit entry first. Fixed asset account accumulated depreciation. Debit fixed asset account to accumulated depreciation account debit, and credit to buyer, buying company, buyer's retained earnings. This is general entry, you can remember. Credit, easy. Not this entry. This is also correct, but then this entry is easy to remember. Then what you can remember? I told you now 3 entries if you can remember. If you look first, selling of fixed assets, if there is any artificially added profit in intercompany trading of fixed assets, that artificially added profit should be eliminated in full. How? The seller's retained earnings debit, seller's retained earnings debit, and fixed asset or property, plant and equipment account credit. As a result of this over calculation or artificially added profit on the property, plant and equipment, your depreciation will be overcasted. Therefore, what we have to do? Depreciation overcasted value should be decreased. Therefore, fixed asset account, or you can say accumulated depreciation account debit, and buyer's retained earnings should be credited. Buyer means the other party. In the case of intercompany trading of inventories, if you can remember, I told you unrealized profit should be eliminated every time from seller. Profit should be eliminated in seller. So therefore, seller's retained earnings debit and consolidated inventory account credit. Understood? Right. Let's see now. Hope we are going to practice this thing. Now I discussed around 30 minutes on this. Just see this question first. Vyoda, shall we do small question? Now let's see this first. Small question. Just have a look on this question first. SSPLC purchased 18,000 shares on 31st right. On 31st March 2010, remember it is 31st March 2010, when SPLC had retained earnings of 10,000, 18,000 out of 20,000. Then first point you have to notice, look, from this 20,000, they will purchase 18,000. Then what is acquisition percentage? Remember, first point that you have to notice is acquisition percentage is how much? 18 over 20 means 90%. 90% acquisition. I remember that point first. Then there are some items, investment, PP, current asset, everything is given. Simple balance sheet. Then if you look these adjustments, 1, 2 and 3, these are 3 adjustments we have. It is a parent's policy to value NCI at fair value. The fair value of NCI on that date, very simple, 2,500. Now we know the double entry. How to pass double entry? Right, sorry for the disturbance. Something happened. Right now, fair value of NCI double entry 2,500. Here, look, you can see now I already done. Cost of control debit, NCI account credit. Now, first one already done. Understand? We'll take one by one. Don't look at other amounts. Those are there, right? I think better to do this again. No? I'll do this on this slide. Easy for me. This is my this is cost of control account. This is consolidated retained earnings. This is retained earnings of subsidiary. This is my NCI account. Cost of control, consolidated retained earnings of this is subsidiary, and this is NCI. These are the accounts I need. I'm going to redo it again because it is not that much clear. Alright, let's start one by one. First double entry for fair value of NCI, and here you have another double entry actually. You can find it. 10,000 retained earnings on the acquisition date. There what you can do, subsidiaries retained earnings debit, I'll do it in thousands. 10. Subsidiaries retained earnings debit and credit to cost of control account, retained earnings. on pre-acquisition retained earnings. That value is given 10. Then next double entry, fair value of NCI. It is about 2000, 2500. Then fair value of NCI 2500. Here credit 2500 means 2.5. Fair value. Here credit and cost of control debit 2.5. Fair value of NCI. Right. It's done. Third adjustment. Not third, second. During the year, S sold. S means subsidiary. During the year, subsidiary sold cost 1600 cost worth of goods by adding 20% profit on selling price. 70% of 20% on profit on selling price. 70% of these goods still unsold with P. P means parent. Now what has happened in this story? Subsidiary has sold 1600 cost of goods by adding 20% profit on selling price, right? Who has sold it? Subsidiary sold it to parent. Subsidiary sold it to parent. Understand? So then if I clarify the story here, don't have space. Yeah, look, this here. Subsidiary sold it to parent. If cost is, now look, but their policy is to add profit on selling price, then profit will be 100, selling price will be 100, profit is 20 and cost will be 80. Cost value is given, it is 1600. Look here, therefore 1600 divided by 80, it is cost amount, cost plus profit will be equal to selling price. Now profit is added on selling price, therefore selling price should be 100. If selling price is 100, margin is 20, then obviously cost will be 80, right? So, but we have cost figure of 1600, therefore 1600 should be divided by 80 into 20 means total profit is 400. But it says very clearly, out of this 400, 70% of these goods, 70% of these goods sold to outsiders. It means, not sold, no? 70% of these goods still remain with the parent at the end of the year. It means the parent has sold only 30% of goods to outsiders. Therefore, what is unrealized profit? Unrealized profit amount is 280. How to take 400 into 70%? Then unrealized profit on inventory is 280. Then double entry should be, I told you, seller's retained earnings debits. Who is the seller in this case? It is subsidiary. Therefore, what I do, I will take it as 0. How much it was? 28. 0.28. Subsidiary's retained earnings debit, credit to inventory, credit 0.28. Understand? Double entry, this is inventory, right? Inventory account credit, seller's retained earnings debit. In this case, seller is subsidiary. Therefore, I recognize unrealized profit into subsidiary's retained earnings. Into subsidiary's retained earnings. It is done. That's all about this adjustment. Understand? This is also done. Now, the third adjustment. A sold rupees 10,000 worth of property, plant and equipment to subsidiary. In this case, who is a seller? A, not A, sorry, made a mistake. Not A, this is parent. Parent sold 10,000 worth of property, plant and equipment to subsidiary for 12,000. Parent sold 10,000 worth of property, plant and equipment to subsidiary for 12,000. It means parent has added a profit of how much? 2,000. Both the companies provide depreciation at 10% on cost. Understood? So now how to incorporate this adjustment? Now what is artificial added profit anyway? It is 2,000. Who has added it? It is by P sold, P, parent. Therefore, first point, if there is any intercompany trading of fixed assets, artificially added profit should be eliminated in full. How to eliminate it? Now, seller is the parent. Therefore, I told you, parent retained earnings debit 2000. Now, 2000 means 2, sorry. Unrealized profit on PPE, seller's retained earnings means parent's retained earnings debit and credit to property, plant and equipment. Credit means minus, I put it as subtract. Right. And what about depreciation now? Parent has added actually a profit of 2000 as a result of that subsidiary or the buyer will provide their depreciation on that amount because the subsidiary's purchase price of this PP will be 12. Or selling price of the parent will be the purchase price of the subsidiary. So therefore subsidiary will recognize this purchase price of 12,000 in their books of accounts and they will provide depreciation in their accounts on this 12,000. But there is an artificial added profit to the group of 2,000. Their depreciation has been overestimated by how much? 2,000 into how many years? It was about 2 years. 10%? 2,000 into 10% for how many years? This transaction was taken place on 31st March 2010. Now we are in 31st March 2012. It means 2 years back. Now over provision of depreciation will be 10% for 2000 into how many years? 2 years. Right. Then depreciation 2000 into 10% for 2 years. 400. It means 0.4. Buyer, who is the buyer? 0.4. Buyer in this case subsidiary because parent sold to subsidiary. That's what. 0.4. Subsidiary's retained earnings debit. 0.4 subsidiary's retained earnings debit as over provision of depreciation and credit to property, plant and equipment 0.4. Debit means plus, huh? Why do you say debit? Debit to PPE or debit to accumulated depreciation. Debit to accumulated depreciation means accumulated depreciation balance goes down. It goes down means PP goes up. Or straight away you can debit to PPE because in this question we don't have separate accumulated depreciation account. We have only PP, property, plant and equipment account. So therefore, we have to debit it into property, plant and equipment because we don't have accumulated depreciation account separately. Alright, that's all. Everything done. Anything else? Yes, that's it. Now we can go in one line by line. PPE 90 plus 25, that 90 plus 25. Look here. 90 plus 25 plus 0.4 minus minus 2, it is 113.4. Then next line, about investment 32,000, it comes to cost of control account as investment 32,000. And stated capital 80, current assets 40 plus 17, 40 plus 17 minus 0.28, it is 56.72. The next line, stated capital 80, share capital 80, subsidiary share capital is 20, it comes to cost of control account as share capital. Retained earnings 80 and 19, consolidated retained earnings 80 and here it is 19 as brought forward balance. And current liability 2 and 3 no change, 5 we can take as it is. Right. Now let's see about first consolidated retained earnings, subsidiaries retained earnings, 19 opening balance, 10 pre, minus 0.28, minus 0.4, finally we have 8.32, this is post acquisition profit, should be split into two, how? 90% and 10%. This into 90% means 7.5 goes to consolidated retained earnings. This is post acquisition retained earnings, and 10% it's 0.82 we'll say 0.82 0.82, it is NCI portion. It goes to NCI portion from post acquisition retained earnings. Can't write now, something happened. Let's see what has happened now. Writing is not fixed now here. Let's see anyway. I'll type till then. Now we can see the cost of control account goodwill. Here about goodwill. How much is the goodwill? 32 plus 2.5 minus 20 minus 10. 4.5 is goodwill. So we can take goodwill here. There is no impairment, 4.5. And then we can close this account. And consolidated retained earnings, it is 8.55. And NCI, $3.32. Finally, this should be balanced. Consolidated retained earnings balance wrong. $85.5. That's correct now. $178.32. Right? Wow, there is difference of 4. There's a difference of 0.8 somewhere. I'll just see it. ඒක නෙමෙයි ලියන්න බෑ මෙතන මේ. ඒ මෙතන. මේකේ ලිව්වට හිටින්නේ නැහැ. මොකද ලියන්න ඕනේ ලියන්න. මේක ලියන්න ඕනේ. හ්ම්. හරි යනවා අන්න ඒක තමයි ප්‍රශ්නේ. හිටින්නේ නැහැ. Is it PP? Let's see. PP 90 plus 25, 90 plus 25 minus 2 plus 0.4. It's correct. Here the mistake. So depreciation. Wait 1 minute. I'll rectify. I identified it. Depreciation. This entry is wrong. This should be in the credit side. Retained earnings of subsidiary of the seller. Buyer's retained earnings credit and PPO accumulated depreciation debit. But I have taken it in this side. That's why I got 0.8 difference. I'll rectify it. Give me 1 minute. Right, okay. Then 0.4 should be in this side. This is depreciation. Ten plus 0.28, 19 plus 0.4 minus 10 plus 0.28. I made a mistake. 19 plus 0.4 minus 10 minus 0.28. This will be 9.18. This is a mistake I did. This should be split into two as 90% and 10%. Then this into 90% is 8.2. This should be 8.2, not 7.5. 8.2, and the NCI portion should be 9.92. Then it will be 0.91. 9 should be 92. You can't write. Right. 0.92 plus 8.2, it's 9.12. Yes, correct. Now my consolidated, these balances should be changed. This should be 2.5 plus 0.92, it is 3.42. Then this balance should be 80 plus 8.2 minus 2, 86.2. Now this will be balanced. 80 plus 86.2 plus 3.42 plus 5. Yes, now it is correct. 174.62. I passed this double entry in wrong way. That's why I didn't balance this answer. Actually, there is a difference of 0.8. And that's all about it. And we'll do only one more question for the balance sheet. A little bit big, but let's try for this. Then we can complete in balance sheet part. Right, let's read the question first. Read these adjustments carefully, just to understand the question first. Look the first one. The inventory of S Limited includes 8,000 worth of goods purchased from K Limited, cost plus 25%. It's about intercompany trading of inventory. The second one, on 1st January 2015, S Limited transferred an item of property, plant and equipment to K Limited for 15,000. Its carrying amount at that date was 10,000. Means we are going to discuss about intercompany trading of fixed assets and depreciation adjustment. The K group values non-controlling interest at fair value. Fair value of NCI at that date was 50,000. Also, S has earned profit for the year 9,000. With that, we can find out retained profit at the time of acquisition. And the fourth one, the loan in S Limited books represents money borrowed from K Limited during the year. Means intercompany trading of intercompany transaction relating to borrowing money. So we have to think about receivables and payables cancellation on that. And the fifth one is relating to receivables and payables cancellation together with check in transit. Yes, right. Those are the adjustments we have. Little bit big question, but let's see what we can do. This is the last question we are going to do in this balance sheet part. Thereafter, we can start the income statement part. And investment value is 76,000. Look here. But if you look investment here, it is 98,000. Balance is something else. We'll see it. 60% on subsidiary. And look the date of acquisition and the model here. Now we are at the end of the year, 31st December. Now we are here on 1st January. Right, this is our model. Investment on that date, straight away I can record into cost of control. This is my cost of control. This is my consolidated retained earnings. This is my NCI account. This is my subsidiaries retained earnings account. These are the accounts I have. Then first entry about investment. it's 76, sorry 76. We can do it in thousands. So 76. It is about investment. Investment 76. Remember the acquisition percentage is 60%. Now look, first adjustment. The inventory of subsidiary includes 8,000 worth of goods purchased from K Limited at cost plus 25%. Now cost plus, it means if cost is 100, profit will be 25, accordingly the selling price will be 125. This includes 8,000 worth of goods, means here look carefully. What is the price that we have here in hand? Which one? 8,000 means its selling price, because inventory includes. So therefore what we have to do is 8,000 divided by 125 and multiply it by 25, then it is unrealized profit. So how much? Just see. 8,000 divided by 125 into 25 means unrealized profit is 1,600. This is my unrealized profit. Now who is the seller? Inventory of S includes means it was purchased from K. K means here look. K means parent, S means subsidiary. So therefore parent sold goods to subsidiary. So then what is double entry for unrealized profit? For this unrealized profit, double entry. Who is the seller? I told you, seller K means parent, debit and credit to inventory, group inventory, credit. I will pass the double entry for this unrealized profit here. 1.6 here URP unrealized profit 1.6. Consolidated retained earnings debit and credit to group inventory. I will write my inventory here. Credit 1.6. We will finalize it later. That's about adjustment number 1. Now adjustment number 2. S means again remember subsidiary here. On 1st January 2015 means at the time of acquisition. S transferred at the beginning of the year, sorry. Yes, at the beginning of the year. Subsidiary transferred 15,000 worth of asset for 15,000, sorry. The carrying value on that date is 10,000 and it has been transferred at 15,000. So therefore what happens? There is artificially added profit of here, unrealized profit on PPE, intercompany trading is how much? 5,000. Double entry, how to account for this amount? Who is the seller? Subsidiary sold it to parent. Therefore, S Limited retained earnings debit 5,000 and credit to PPE or group PPE credit 5,000. Right? So then I will pass the double entry. Subsidiaries retained earnings debit URP on PPE 5,000, I'll do it in thousands, and credit to PPE 5,000, it's minus, right? And also we have to think about depreciation, over provision of depreciation as a result of this artificially added profit. Artificially added profit by subsidiary to parent is 5,000. On that, parent has provided depreciation based on the remaining useful lifetime of 5 years. Remaining useful lifetime of 5 years means this 5,000 should be divided by 5. So then over provision is how much? Let's see. Over provision of depreciation, 5,000 divided by 5 is how much? 1,000 only for 1 year because acquisition happened at the beginning of the year. So double entry for over provision of depreciation. What's double entry? Who is a buyer now? Parent. Therefore consolidated retained earnings debit 1,000 means 1 in my example, and credit to a mistake. Consolidated retained earnings credit 1,000 and debit to PPEO, you can say accumulated depreciation debit. PPEO accumulated. Now in this example actually we don't have accumulated depreciation. Right? So the double entry for this over provision of depreciation we have to reverse now. I am going to reverse over provision of depreciation. The accumulated depreciation debit or PP debit 1,000. Debit means here plus 1,000. This 1,000 is depreciation. Is unrealized profit. And credit to who is the buyer? Here, therefore, over provision of depreciation credit consolidated retained earnings account. Right, that's all about it. Now third adjustment. K group, the K means the parent. Value is NCI. Fair value of NCI is given, very easy. How much it was? Fair value of NCI is 50,000. We know the double entry for fair value of NCI. Debit to cost of control 50 and credit to NCI account. And they say that profit for the year is 9,000 means you can find out profit at the date of acquisition. Now this is profit at the end of the year. How much? Look. Profit at the end of the year, here it is 69. 69. During the year it is 9 means at the beginning of the year profit should be 60. Right? This is the acquisition date. Therefore we call it pre-acquisition profits. Double entry for pre-acquisition profit is pre-acquisition profit. here 60 subsidiaries retained earnings debit and credit to cost of control account. $60. Right. Then a fourth one. The loan in sub S Limited's books represent money borrowed from K Limited during the year. All the loan note interest has been accounted for. Look, is there any loan receivable and payable? There is loan given by this. Look, 20 here. There is a loan given here, 20, and here the investment. Actually, this is 76. What has happened here? Look. There is investment of 98. There is investment of 98,000. Out of that, 76,000 is made for subsidiary acquisition. There is balance 22,000. What is this 22,000? It is about this loan provided by right, and they are talking about interest as well. Then interest component on that is they have recognized interest in, where is it? Then balance is interest. Then there is interest received inside it is 2000. Therefore, this loan should be cancelled each other first. Loan balance here should be 0. And also there should be receivable interest. They have accounted for interest receivable of 2000, and there is current liability here 20,000. From this we have to subtract 2000 as interest, because they have recognized under current liability as interest payable. K Limited has received it as interest receivable. It is not intercompany interest income transaction. right? So therefore, what we have to do, it should be eliminated in full from current liability. We have to subtract 2000 as interest payable to parent. Right. The another one is then the investment will be reconciled. Huh? Remember, investment, total investment 98,000, out of that 76,000 to buy the subsidiary, 20,000 the loan given to the subsidiary, and balance 2,000 interest receivable from subsidiary as interest. Then 98,000 will be reconciled. Then total of this will be 98,000. Right? Included in K Limited's receivable is 4,000 relating to inventory sold to S Limited during the year. There is another receivable in K Limited receivables relating to inventory sold to S Limited during the year. Subsidiary has raised a check for 2,500 and sent to K Limited on 29 December, but it has been received after the year end. It means there is check in transit of 2,500 should be cancelled from receivable of K. Therefore, what we have to do first, anyway, there is a receivable of 4,000. We have to cancel that intercompany receivable 4,000 in full. Then what should be the double entry here? Check in transit, debit 2,500, payable account, debit 1,500. We have to cancel all receivables. Therefore, consolidated receivables credit. How much? 4,000. This should be entry 4, a cancellation of intercompany transaction of receivables and payables. Understand? So double entry. Receivable credit 4,000. Credit means minus 4. Check in transit debit. Debit means plus 2.5. And credit to payables. Another minus 1,500. Check in transit debit, payable debit, and receivable credit. Payable debit means again we subtract from this 1,500. Right. That's all about this, and now we will finalize figures. PPE 138 plus 115. There are adjustments. Minus 5 plus 1. Then final balance here will be 249. Investment 98, inventory is 15 plus 17. 15 plus 17 minus 1.6. It is 30.4. Receivables 19 plus 20 minus 4, it's 35. Sorry. Cash 2000. Cash 2000 and check in transit 2.5, we can take as it is. And next line is share capital. Share capital 50 and 40. Here share capital 50, subsidiary share capital 40. Next line, retained earnings 189 and 69. Brought forward balance here. $189 and subsidiaries retained profit brought forward. $69. Loan done, cancel. Current liabilities 33 plus 23. Then current liabilities 33 plus 23 minus 2 interest receivable minus 1.54 cancellation of trade receivables. Then total will be 52.5. Now we close this one. First subsidiaries retained earnings 69 minus 5 minus 60, then balance is 4. This post acquisition reserve four should be split into two as 60% and 40%. Therefore, from this four into acquisition percentage is 60%, no? Yeah, 60%. 2.4 and here $1.6. Balance goes to NCI, post acquisition profit. Then this account will be closed. And we can close cost of control account. Goodwill on consolidation is 25. We will take goodwill here. And NCI consolidated retained earnings balance directly we can take now 189 plus 1 plus 2.4 minus 1.6 Then consolidated retained earnings 190.8, and NCI 51.6. Now this answer should be balanced. Let's see. This side total will be 343.9. This side 1 difference. There is one difference. What is it? Goodwill wrong. Yes, it's not 25. It's 26. Yes, it is balanced by 344.9. Right, fine. Hope you understood something about group financial statements, and I need to discuss a little about at least to have kind of basic understanding about consolidated income statement. So therefore quickly let's run through this. Actually most of the adjustments we have discussed, only thing you have to think about the impact of these adjustments to income statement. It won't be a big issue, but at least you have to draw your attention for basic adjustments relating to group financial statement in income statement. So again we do like in balance sheet, we do line by line consolidation, line by line adjustments or line by line consolidation. And let's have one question to see with how we can prepare this quickly. At least to see one question today, and we can do the rest tomorrow. Not tomorrow, next week. Just see this one. Here we have only one adjustment. The main component is split in of profit after tax for the year. We don't have any other adjustment in this income statement. Turnover, cost of sales, GP, administration, distribution, finance cost and others are given. Only thing we should understand how to present this information in group financial statements. Since we don't have adjustment, again we do line by line consolidation having equal items together. Therefore revenue should be how much? 75 plus 38. I am going to do this quickly. $113 right. Next line we don't have again adjustments. 30 plus 20 50. Cost of sales within bracket 50. No change. Then gross profit will be 63. So 63. Then what about distribution cost? Distribution, administration, everything we can subtract very easily. Finance, shall I take everything together? Okay, I'll take separately. 12, 17, 7. $36. Then profit before tax is 27. Income tax 5.4. And profit for the year 21.6. Now the next part is this profit for the year should be split into two. It is kind of group requirement, group accounts requirement. Should be split into two as profit attributable to parent and profit attributable to NCI. Therefore, after this there is kind of addition here. Attributable to shareholders of parent and NCI. That same profit should be divided into. For this thing actually I can write you a formula. Now this is total profit of 21.6. Here also same. Look, if you take the sum of this 16 plus 5.6 is 21.6. Same. Now this profit should be actually now for the parent and NCI because this is 80% acquisition subsidiary, right? So therefore the total profit for the group is 21.6. Out of this, group should receive only 80%, but you can't take as it is. Why? The total parent profit is 16,000 for the year inside this. Total parent's profit will be entitled to the group. Subsidiary earn 5.6 profit or 5,600. Out of that we can get only how much? 80%, but again not total. Only after acquisition. Because on the acquisition date we had 1,400 profit, now total profit for the year 5,600. Now total profit, now look here 3,400. So therefore we can take a general formula for this thing like this. Profit attributable to NCI equal NCI profit for the year plus or minus adjustments if any into group percentage. Now look, what is NCI profit for the year? 5.6. There are no adjustments. There are no adjustments. Therefore, plus O minus 0 equal that into as a percentage of accretion 80%. Answer is 4.48. Then NCI value should be 4.48. Balance should be attributable to whom? 21.6 minus 4.48, it is 171.2, it is to the other parties. That's how we have to split that, not 171, made a mistake, sorry. 17.12, made a mistake here. 17.12, right. So that's how we should split this profit attributable to shareholders of parent and non-controlling interest. Is it? Usually, what how to verify this 17.12? Total profit of the parent is how much? 16. That means parent's profit plus subsidiaries profit plus O minus adjustments. I am writing a general formula for this. Into here I made a mistake, sorry. Here I should take only NCI percentage. It's a big mistake. Not 80%, I made a mistake here. Just see, only 20%. Here we have to take group percentage. Parents profit, if there is any, now in this case we don't have adjustment. In next questions we can see some adjustments. Parents profit for the year plus or minus adjustments plus subsidiaries profit for the year plus or minus adjustment into group percentage. Now what is parents profit? Look here, now I am going to take the figures now. Parents profit 16,000 for the year, no adjustment, we can take as it is. That plus subsidiaries profit is 5.6 into no adjustments again into 0.8. Here it should be how much? It should be 20 point, yeah, the answer is wrong. 20.48. and this balance should be 1.12. Here it should be, this is wrong. 5.6 into 0.2 means 1.12. Now it's correct. Your balance 20.48. We learn only one point today in income statement. How to account for this, how to record this profit after tax for shareholders of parent and NCI. So we'll do at least one question next week relating to this income statement, and thereafter we can see the rest. I think income statement I don't want to focus that much. I need to discuss only the statement of financial position. Today there's a problem in the system because we can't write this thing, everything should be typed, so it takes time. So in income statement it is quite difficult. So therefore next week I'll do at least one sum from income statement, and thereafter I'll move to the next part of income statement and in the syllabus. And so therefore I am going to stop from this point. Actually the system is not working, I need to restart. If I restart it takes time. Right, with this we will wind up the today's session, and I have completed already everything about balance sheet or the statement of financial position and started income statement. Discuss only one adjustment from the income statement. It's about how to split profit for the year into shareholders of parent and NCI. That's the only part we learned today. So then next week we will continue the rest of the things. Then thank you very much.